How's it, guys? Today's video will be short and sweet. We will be talking about the trade drives pattern. Basically, we are going to look at what is it, why does it form, and how to trade it. So let's get to the theory part of the video. So the first thing that you need to confirm your trade drive pattern is you have to have your liquidity pool, either buy side or sell side. So when you have your daily or higher time frame bias that the market is going into a certain direction. In this example, we're using a bearish bias. So on a higher time frame, we are looking at the market being bearish. So for the market to sell, it has to take out buy side liquidity first, because the market take out buys and sell in a premium before it goes down. So what you have is you have the market making a low, then the high, then the low, then a higher high, then a higher low, then a higher high. So how do you anticipate that the trade drive patterns will form? You anticipate the trade drive pattern when the market start moving sluggishly. What do I mean when the market start moving sluggishly? If you can see from here to here, the market has been making very big pushes up and down. This is a very big leg up. Then the retracement is also big. Then another big push up. Then another retracement which is big, and another big push up. So when it gets to this price here, you start seeing the market moving very sluggishly. That means it's no longer making bigger push and bigger retracement. So after making this high, the retracement here is not that much powerful. So it's a little bit of a retracement, and the market goes high with a little bit of a displacement, but not the same as from the beginning. Then when this happened, you realize that we are approaching our buy side liquidity. That means this is our first high. Becomes our first drive, and the market makes our second drive here, making this higher low, and the market makes a third high. So when the market makes this third drive here just beneath our buy side liquidity, then you are confident that this liquidity will not be taken just yet. So now we have the market making a low here, and the market failing to make a higher high. So this high was supposed to be a higher high, taking out this liquidity, but instead it made this low here. So now this gives us further confirmation that the drive patterns have formed. Now what we're looking for is we're waiting for our market structure shift. So now we have the market dropping below this low, confirming our bias that is bearish, that we have a break of structure. Now we have our market structure shift by breaking this low. So the market closes below this low. This is confirm our market structure shift. So what you do is you wait for the market to go back into a premium market after breaking this low, after confirming our market structure shift. Then you take your sell position there and you target the sell side liquidity. So the most important thing is the drive patterns form just before the buy side liquidity, and it doesn't take out the buy side liquidity. So when you're using your entry here, you can either use the breaker block, you can either use the mitigation block or the order block or the fair value gap using the 2022 model. Okay, your entry is going to be here at a 50%. Then you hide your stop loss just above this buy side liquidity, because the market should not go above this buy side liquidity. But if you want to increase your risk to reward ratio, you can hide your stop loss just above this high, because this market structure shift here confirms that price is going to attack the sell side liquidity first before coming for the buy side liquidity. So your target is going to be the buy sell side liquidity. So your entry point is going to be something like this at the 50% or at the open. Then you target the sell side liquidity, then you hide your stop loss above this protected low or above the buy side liquidity. Okay guys, now that we've understand the theory part of this concept, let's go to the chart and look at a few examples. Okay guys, for our example, we are on the Nasdaq 100 E-mini futures on the 1 minute time frame. Okay, now let's look at our bias. Go to the left, you realize that we have this market structure shift here. This confirms to us that the market is going bearish, right? The market is going bearish to attack further liquidity supply, so it can target this sell side liquidity or whatever sell side liquidity that you can see. So this is our target, because it also have this fair value gap here, but let's not talk about that. So now let's go to the example. So now we have this bias that the market is going to go down and attack this sell side liquidity to the downside. So what do we see? We have our high here, and the market made a high here. So the market made a high, a low, a higher high, a lower low. Then when the market makes this, then you start to see that here we have a huge expansion, and here we have a huge retracement. So we have a huge retracement, a huge expansion. But here the market starts moving sluggish. Starts moving sluggish, then that's when we anticipate that our trade drive patterns are forming. So this becomes your first drive, this is your second drive, then the market makes your third drive. Then it doesn't, if it fails to take out this buy side liquidity, instead we have a break of structure here with this candle closing below this low, and we have our market structure shift with this massive candle down here. And this, if you can see, this candle is disrespecting the bullish fair value gaps or the bullish PD array. So we can assume that when we have this market structure shift with this intensity here, this sell side liquidity can be our next target. So what do? We wait for the market to retrace into your entry trigger. It can be what? An order block, which is the last, these candles, these up candles here. It can be a breaker block, which is this candle here. It's a breaker block because you have a high, you have a low, you have a higher high, then you have a lower low. So this becomes your breaker block, or this becomes your order block, or you can use this fair value gap. So let's use this fair value gap as your entry. Entry will be here. Go short at the open or at the 50%. But if you, but then I would suggest that you use the open of the fair value gap, because you can see it aligns perfectly with this breaker block. So the open of this fair value gap, where you hide your stop loss, you can hide it above this high, but the stop is too much, so you can hide it above this set drive, and you target this sell side liquidity or the higher time frame sell side liquidity. But for more to be safe, just target this liquidity here. So this will be your trade, right? You enter here and you take your part here. So now you can realize that this becomes our next target now, because this sell buy side liquidity has to be taken after this sell side liquidity is being taken, because the market cannot go down without first taking this buy side liquidity. But now the market has no reason to go down because it tapped into the sell side liquidity and higher time frame sell side liquidity. So now we anticipate the market going up. Okay guys, that will be the end of the video. So if you've enjoyed this video so far, please consider subscribing to my channel, like and comment under this video. Give me suggestion on future videos, what you liked about this video, or this style of presentation, if I can continue with this one, or you like the past one better. Please subscribe. See you next time.